Cloudflare is a cloud service provider that offers several services to businesses worldwide. But is the stock undervalued? Is the price undervalued at the current trading price of $115? I'm going to answer that question in this video by conducting a discounted cash flow value analysis on Cloudflare stock. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So to make this estimate, I'm going to use several inputs, and one of which is the company's beta. According to Yahoo Finance, the beta for Cloudflare stock is 1.1. I also need the company's market cap, cash balance, and long-term debt, which stand at $34.4 billion, $183 billion, and $1.3 billion, respectively. I also need the company's average diluted shares outstanding, which are 342.36 million as of the latest update. And I need the Wall Street analyst's estimate for the company's free cash flow over the next several years. And accordingly, these cash flow estimates are $160 million for 2024, $220 million for 2025, $330 million for 2026, $680 million for 2027, and $990 million for 2028. All right, so now that we have the inputs we need, we can jump into the discounted cash flow model. Starting with this cell here, the $160 million estimated for 2024, and increasing all the way to $990 million by 2028. These are the numbers I got from Wall Street analysts making these forecasts. From 2029 to 2034, I used my own forecast for free cash flow. I forecast that the company's transition period growth rate in free cash flow will be 29%. And the way I do that is I took the cash flow growth rate in the first 4 years, the first 5 years up until 2028. And the free cash flow growth rate for those years, the compounded annual growth rate was 57.8%. So I took 50% of that for the transition period growth rate at 28.9%. So between 2029 and 2034, I forecast the cash flows growing at 29% compounded annually. And so this has the company's free cash flow growing nicely all the way up to $4.5 billion in 2034. From 2035 onward, I have the company's free cash flow growing at the long-term rate of 5%. The reason I use 5% is because this is the rate I expect developed economies to grow nominally. Real GDP, real growth rate might only be 2 or 3%, but nominal growth rates I forecast to be around 5% for the long term. This combines inflation and real GDP growth. So these are free cash flows expected in the future. What we need to do is get the present value of these cash flows. How much are they worth today? And that's the number you see underneath, is the present value of this cash flow expected in 2027. I discount these cash flows using a weighted average cost of capital of 10.84%. I arrive at this number by assigning an 8.5% cost of debt to Cloudflare and a 11.1% capital asset pricing model cost of equity, utilizing the beta of 1.1, a risk-free rate of 4.5%, and a market risk premium of 6%. Since the company has a market cap of $39.4 billion and total debt of $1.3 billion, I've given the company a target capital structure of 10% debt and 90% equity. And so when I combine all of that, I get a weighted average cost of capital of 10.84%. And so when I discount all of these cash flows back to today, the present value of these cash flows are $8.52 billion. Now, I don't usually do this, but this time I'll talk about the formula to discount these cash flows. Reason I don't do it is because I feel like it's a little bit wonky. I talk about these factors when I'm evaluating companies using my in my corporate finance class at university. So I feel like it might be a little too advanced for the general viewing public. But the way I discount cash flows is you take the expected future cash flow, you divide that by 1 plus the weighted average cost of capital to the power of the number of years that you're discounting. So if you're discounting from 2025, that would be just 1 year of a discount, right? So you just have 1 as the numerator. Okay, so that's how I discount those cash flows. Now we have the value of operations at $37.7 billion for Cloudflare, and the value of operations at $37.7 billion. So when we take that value of operations, we need to add the cash balance of 183 million, subtract the debt of 1.286 billion, and we get the value of equity at $36.6 billion. But we want to know the price per share. So we need to divide that value of equity by the number of shares outstanding, which brings us to the intrinsic value per share of $107 for Cloudflare stock. The current market price is $115 for Cloudflare stock. Now, when I'm trying to answer the question, is a stock undervalued or overvalued? I like to give myself a margin of safety between 5 and 10%, depending on the stock. And in this case, I like to go closer to 10%. So a value of $107 with a market price of 114, my conclusion would be that the stock is fairly valued. It's not too expensive and it's not too cheap. Now, that doesn't mean that the price is going to stay at $107 and never increase. It just means that the current market price is fairly valued for Cloudflare stock, and investors can expect a reasonable rate of return for holding this stock over the next several years. In fact, the rule of thumb is to expect the rate of return similar to the cost of equity for a business or the weighted average cost of capital for a business. So in this case, around 11% rate of return could be expected for owning Cloudflare stock and holding it for 5 years or 10 years or however long your holding period might be. Of course, you noticed I used several estimates and assumptions to make this calculation, so it's highly uncertain. I recommend doing your own due diligence before making any investment decisions, and should be for entertainment purposes only. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.